So greetings traders. Today I am going to post my first video tutorial on how to use one of the best indicators in the industry to trade possibly any market, whether it's forex, whether it's equity. It is universally applicable to all of these markets. Well, today I am going to show you how you can use weighted moving averages in combination with VWAP, that is volume weighted average price. And volume weighted average price is basically for a single session, and weighted moving averages are a carry forward from previous sessions. They continuously span over different sessions. So I prefer trading in Bank Nifty and Nifty in India because I trade in Bank Nifty mostly. So I'll explain you with examples from the trades in Bank Nifty, because Bank Nifty is one of the most volatile markets in the world. And so you can have better idea in the instances of the session, different instances, how the market moves in accordance with the weighted moving averages and VWAP. So let's get started. So charting software which I use is TradingView. You can use any other charting software provided it has the indicators that I'm going to suggest you now. So when you log into TradingView, go into indicators section and type WMA and 22 and apply 4 WMA ribbon here provided by RK and KR. Okay, let me see. Okay, it has applied then, and next you need to apply the VWAP. Apply VWAP, volume weighted average price. Okay, and thirdly you need to apply simple moving average, that is moving average, and you should select the 50-day setting here. You should change the setting to 50-day and select OK. Now first of all, let me clarify why I'm using 50-day simple moving average and why I am using it with weighted moving averages and VWAP. First of all, let me tell you why a period of 50 days. 50 days because I am trading intraday, and 50 days is regarded to be perfectly suitable for intraday trading. If you are trading in long term, then you can look out for 100-day or 200-day simple moving average based on your preference. And secondly, let me tell you that why weighted moving averages are so precise in spite of being lagging indicators, why they help us in knowing how the market will move forward. See, weighted moving averages compile the actions based on volume and price. So how much volume is there in a particular instance of a session, and how the price is moving can tell you probably how it will move ahead in next few minutes. So this is why WMA is the best indicator that I consider for trading. Now why I am using 50-day moving average with weighted moving average, 50-day weighted moving average with 50-day simple moving average. The simple reason being that whenever I see that market is going up or down, I can also have an idea about whether the weighted moving average of 50 days, this yellow line here is the weighted moving average of 50 days, is above or below the 50 days simple moving average. See here, both of them became flat, and here they started ascending again. They gave a reversal and they started moving up, and afterwards the 50-day simple moving average came down. So what did it suggest? That at least now the price is fairly priced in terms of 50 days, because 50 days moving average, weighted moving average, is above the 50-day simple moving average. So you'll get to know. If you are feeling confused right now, don't worry, you'll understand after I explain you. So let's get started. So this is the point from where the market started today, and just observe that VWAP is well below the all of the moving averages. See, weighted moving averages, VWAP is well below all of these weighted moving averages. So what does this suggest? That and in the starting the price was well below the volumes that were actually placed before. So volumes were in the starting of the session, the volumes were well above the VWAP when the market opened. So there was a fair chance of the market going up today. But here in India on Thursday, Bank Nifty has an expiry. It is options expiry. So traders take many positions, and so today the market was very much volatile. It tried to move up, but then it was pushed down by high selling volumes, and volumes are always the key in determining how the market will move. So weighted moving averages are very much important. Now let's see how the market moved. See, when the market started, it won't have gone down straight away. It tried to consolidate. See here, it tried to consolidate because the weighted moving averages, as I said, were well above the VWAP. Now see here, this red line is 22-day weighted moving average. This yellow line is 50-day weighted moving average, and this dark blue line is simple moving average, 50-day simple moving average, and this blue line is 110-day moving average, and this is 200-day moving average, the green line. All of these are weighted moving averages except for this one. This is simple moving average. So as I said, the market tried to consolidate, but just observe this curve. When this curve is on a downward slope, there is no chance that the price will go up, no matter how much it tries to do so. And once it has to come down and again retrace with better volumes, so that this curve bends from downward to upwards. See, then the market again moved up, and this time it crossed the 22-day moving average, because it was not on a downward slope, it was not on a decline. It was showing that the volumes were starting to shoot up in favor of buying, and so a surge in prices was observed. So please keep in mind one thing, that lower the time period of weighted moving average, the greater is the elasticity. Means it can bend in favor of the price, in favor of the volumes very fast if it is of a small period. This 22-day moving average is moving, just say that this 22-day moving average is moving very fast than the 50-day moving average, 50-day weighted moving average. So what I was saying, that when this is on a decline, it is difficult for the price to go up, and nearly impossible for the price to go up, because volumes accumulate in a downward fashion on this slope. It is already indicating that it is declining still. The volumes in favor of buying have not superseded the volume in favor of selling. So selling pressure is higher here, and once it has to go down far enough so that when it retraces, this curve will bend and it will start on reversing, and the trend will reverse. So for that particular time, the price is surged and it crossed the 22-day weighted moving average finally, when this curve bent and it started moving up. So this kind of setup is far better on a 5-minute time frame, and you can also have 1-minute time frame here and see what is happening in the short time. As we discussed, the frame that we discussed there, see here what happened. Here the 50-day weighted moving average curve was bending upwards, and so the price is surged here. You see the 22-day weighted moving average crossed the 50-day weighted moving average and started going above the 50-day weighted moving average. So here in this portion, you can see that the prices moved up because the 22-day weighted moving average slope was was ascending, was on an upward slope. So it and also it crossed 50-day weighted moving average, so prices surged up. That is around 9:30. See, that is around 9:30 here, and on a 5-minute time frame, here it was on 10:35 that it happened. So let us see 10:35 where how the prices performed, how the prices acted. See, sorry, how the prices behaved. So see, here it took support, and see, until the 22-day weighted moving average curve was declining, here it was trying to build support. Prices did not go up, and as soon as the curve started flattening and moving up, the prices started moving up. So this is the beauty of weighted moving average. And here see the another example. As a 50-day weighted moving average curve was on a decline, the prices found it impossible to go up, so it was pushed down heavily from above, and it had to go down again when the 50-day weighted moving average flattened and started reversing. Prices again crossed weighted moving average curve of 50 days and surged till they reached 110-day weighted moving average price. But here was the same situation. This was on a decline, so they pushed down the prices, and ultimately here it's struggled to go up, as the 22-day weighted moving average curve was on a decline. It touched the 22-day weighted moving average curve, but it ultimately fell down. It collapsed. The prices collapsed, and here again at the support level it took support. See, here the curve was on a decline. Until it was on a decline, it took support, and as soon as the curve reversed and retraced, the prices shot up again. And here again the 110-day moving average was a barrier. It was not able to cross that barrier, and that was the end of the session. And so this is the beauty of weighted moving averages. You can plan, and in a 1 minute, why it is you are required to watch 1 minute and 5-minute time frame both. So let me tell you here. See, See at 11:24 this started declining again, and from there the prices fell again. Now what was happening at 11:24? See, here it is at 11:10. 11:10 it did not allow this to go up, and it formed a bearish candle, a red candle. But how can we confirm that the prices will come down again? That is where 1 minute time frame is very crucial and helpful. Around 11:15 it was facing resistance still. The prices were not ready to go down. See, but then ultimately 11:24 the prices went down. See here, this is the candle of 11:25, where it actually the prices fell down. There was a steep fall in the prices. So this is the beauty of weighted moving averages. If you apply them, you can understand whatever the trend of the market is, you can understand when you can exit and when you can enter the trade. So thanks for watching. One thing that I forgot to mention here is that I want you to make an important note of the behavior of weighted moving averages is that all the weighted moving averages, when you observe all the weighted moving averages, when the smaller day weighted moving averages are above the greater day weighted moving averages, the price action is considered to be bullish. So if 22-day weighted moving average is above 50-day weighted moving average, 50-day weighted moving average is above 110-day weighted moving average, and 110-day moving average is above 200-day moving average, and all of them, if they are on an upward trend or are on an upward slope, then the probability is very much high that market after retracing will go up. Market will be bullish for the entire day if from the start to the end, if these weighted moving averages are placed in this manner. So always keep in mind that price will be bullish if smaller time frame moving averages are above the higher time frame moving averages. Thank you.